Ever looked at a business and wondered if you're seeing the whole picture? If it's actually healthy or just good at looking the part? Well, the secret is in its language. Today, we're going to learn the 6 core principles of accounting. Think of it as the grammar every single business uses to tell its financial story.
So, how do you actually tell that true story? How can you look at a company and get what's really going on? It's not about some secret formula or magic trick. It's about knowing the universal language that all businesses speak.
And that's really the key here. It's a set of rules. Every business, whether it's the coffee shop on your corner or a massive global corporation, has to follow these same principles. And that's what creates a foundation of trust and allows us to actually compare them fairly. So let's see how it all works.
Here's our roadmap for today. Think of it as building a mental map in 3 key stages. First, we're going to lay the foundation. Then, we'll get into the nitty-gritty rules for recording transactions. And finally, we'll look at the guardrails, the things that keep everything honest.
So, this is what our journey looks like. We're going to start with the big picture stuff, the who and the why. Then we'll move into the how, the day-to-day tracking. And we'll finish up with the principles that make sure the story is a truthful one. Let's start with that foundation.
All right, let's jump right into part 1, setting the foundation. These first 2 principles, they're the absolute bedrock of all accounting. They help us answer 2 really simple but critical questions. Who are we even accounting for, and how long do we expect this whole thing to last? First up, we have the business entity concept. This is so simple, but it is absolutely crucial. All it says is that the business is its own financial person. It is completely 100% separate from its owner. The business's money is not your money. And you can see right here why this matters so much. Let's say Aisha owns a bakery. If she buys flour for the bakery, that's a business expense. But if she uses the business card to buy a new pair of shoes, well, that's personal. Keeping these things separate prevents a ton of confusion. It offers legal protection. And most importantly, it gives you a true, accurate picture of how the bakery is actually doing. Okay, next is the going concern concept. You can think of this as a rule of optimism. We always assume that a business is going to keep operating for the foreseeable future, that it's not about to just shut down and sell everything off. And this idea totally changes how we value its assets. It's so important, in fact, that auditors have to call it out if they have any doubts about it. And this example just illustrates the point perfectly. Let's say a van was bought for around $16,200. If the business had to sell it tomorrow in a panic, they might only get, $8,100 for it? Maybe. But because we assume the business is a going concern, we value that van based on its usefulness for making future deliveries, not its fire sale price. All right, so our foundation is set. Now let's move on to part 2, the rules of recording. We know who we're accounting for and that we expect them to stick around. Now we need the rules for how and, maybe most critically, when to record all the financial activity. And this brings us to the accruals concept, which is a total game changer. It says you record income when you earn it, and you record expenses when you incur them. And this does not always line up with when money actually changes hands. This approach gives you a much, much truer picture of a company's performance in any given period.
So, for instance, imagine you complete a job for a client in December that's worth about $1,350, but the client doesn't actually pay you until January. Under the accruals concept, where does that income go? It belongs to December. Why? Because that's when you did the work. That's when you earned it. Our 4th principle is consistency. And, it's pretty much exactly what it sounds like. Once you pick an accounting method for something, you have to stick with it. This is so important because it ensures that when you compare this year's financial results to last year's, you're actually comparing apples to apples, right? So a company can't just change how it accounts for the declining value of its assets, a process we call depreciation, just to make its profits look a little better this year. If a change is really necessary for some reason, it has to be justified and it has to be clearly explained to everyone. It's all about creating reports that are reliable and trustworthy over time. And that brings us to our final section of principles, the essential guardrails. You can think of these last 2 as the conscience of accounting. They make sure the financial story being told is both cautious and relevant. So, the prudence concept, sometimes called conservatism, is all about being cautious. When you're faced with uncertainty, you always choose the path that is less likely to overstate your profits or assets. The old saying fits perfectly here. Don't count your chickens before they hatch, but you should definitely prepare for a fox in the henhouse. This slide shows that cautious approach in action. You only record potential gains, like, say, a lawsuit you expect to win, when that money is pretty much guaranteed to be in the bank. But potential losses? Oh, you record those as soon as they seem reasonably likely. This stops a company from painting a picture that's way too optimistic. And our sixth and final principle is materiality. Honestly, this is the common sense rule. It basically tells us to focus our time and energy on the numbers that are actually big enough to influence someone's decision. In other words, don't sweat the small stuff. Think about it. For a big company making, say, $2.7 million in revenue, is it really worth the time and effort to track a $4 stapler as an asset over several years? No way. Of course not. It's what we call immaterial. So you just record it as an immediate expense and you move on. It's all about being efficient and focusing on what truly matters. Okay, we've built our entire map. We've got the foundation, we've got the rules, and we've got the guardrails. Now, let's just take a second to put your new knowledge to the test and make sure all of these concepts have really clicked into place. All right, here are 3 quick scenarios for you. Take a moment, maybe even hit pause, and think about which one of our 6 principles applies to each situation. So, how did you do? Let's check the answers. That personal vacation paid for from the business account, that's a clear violation of the business entity concept. The sale made in March has to be recorded in March when it was earned, all thanks to the accruals concept. And no, a company can't just randomly change its methods because the consistency concept demands stability. And that really is the key takeaway from all of this. Accounting isn't just about math. It's a full-fledged language. And these 6 principles we just went through, they are its grammar. Now that you understand them, you have the power to read and to truly understand the financial story of any business out there. You now have the fundamental toolkit for understanding the language of business finance. You know the rules of the game. So the only question left is, what story will you now be able to read? Or maybe even tell yourself?